Hello and welcome to week 6, lecture 1. This week we are talking about retail strategy and financial outcomes in our retail management BUS302 course. And let me just say, I am so excited about the lecture material this week. As some of you know, I am a CPA. And so anytime we talk financial outcomes and strategy, I get super excited. And so some of the things that we want to do and focus on this week are we want to look at the financial strategy of a retailer. We want to look at two paths that of financial performance that can affect our profit. We want to evaluate a couple measures that retailers can use to assess their performance. We want to also talk about pricing merchandise and why retailers take markdowns, and how we connect the financial strategy with the pricing. Last thing we're going to talk about are some legal and ethical issues that retailers should use when they are pricing merchandise. So I'm so excited about this week. I don't want to waste any more time. Let's just dive in and let's start chatting about strategic objectives and goals, right? So whenever you have a strategy should result in value creation, right? So value is normally thought of as some sort of financial measure, right? So when we start thinking about strategy and goals, you have to have some type of financial objective, like a return on asset or something like that, right? Now, obviously, your goals can also be like, hey, we want to make the world a better place to live. So something for society. That's hard to measure. It really is. Personal objectives for a small independent business owner, if you're going to be a retailer and you're going to be sole prop or something like that, right? The fact that you want maybe a certain amount of status or respect in the community, or maybe it's just something you enjoy. Those are personal objectives. But again, you need to have some type of financial objective, right? At least you should, like return on assets. Now, when we start looking at this, understanding that these financial objectives can be measured with numbers, right? Numbers, accounting numbers and finance numbers, dollars and cents. This is how we keep score in business a lot of times, and it is somewhat unfortunate that this is how we keep score. But there is this idea of a strategic profit model. So understanding all the factors that affect your performance, right? Especially when we talk about return on assets. Now, when we talk return on assets, here's what I want you to think. Return on assets really is a very simple thing. It is return. Return is net income. Okay, so that's all it is. Net income, and we're going to divide that by our total assets. That's really all return on assets is. We take our net income and we divide it by our total assets. And so when we start thinking about that, understanding all these things that affect that, right? We start off and go, okay, well, net income, that's profit margin, right? So how much profit we make, right? So when we start talking profit margin, we take our profit and divide it by our sales, right? So that's one side. And then we look at the other side, which is assets. Now, assets are all those things that are going to benefit you in the future. So we take a look at that. Now, they use the asset turnover model, which is net sales divided by total assets. The more you turn over your assets, which is true, the more you turn things over, the better you're going to do, right? If you multiply your asset turnover by your net profit margin, you're going to get return on asset. That's what happens. That's a strategic profit model. So we look at the various aspects of this and say, hey, how does this all come together, right? So in the profit margin path, we start off and we look at what's called an income statement. Some places call it a statement of operations. Others call it a P&L, profit and loss statement, right? And basically what this does is it tells you how your organization has performed over a period of time. It could be a quarter. Today is the 1st of July when I'm recording this. So we've just finished the first 2 quarters of the year, right? It could be for a year. We generally look at this in a year time or maybe every 3 months, right? So an income statement. Now, an income statement, these are two companies that, I've mentioned in other videos. You have Target and Walmart. So as you go through and you look at this, an income statement will always start with your revenue, net sales. What was our sales? How much did we bring in? Now, as I've already mentioned in a couple of videos, that Walmart is the world's largest retailer by revenue. So Target is, I think, the second largest. I don't know if they're the second largest discount retailer, traditional discount retailer. Amazon would be the second largest retailer as a whole. But so when we start looking at this, right, Walmart had $519 billion. Well, actually, we'll just round up $520 billion in sales. Target had $77 billion in sales as of fiscal year 2020, right? So we look at those dates, those same things. Cost of goods sold. How much did it cost? Now, that's how much the inventory cost. So all the sales, that's what they brought in from selling it. The inventory that they sold cost, that's the cost of goods. We get to gross margin. That gross margin, that's how much is left over after you pay for your inventory. That, to me, by the way, net sales minus your cost of goods equals gross margin. That, to me, is the most important formula in business. The reason is that number, whatever your gross margin is, has to pay for everything else that is listed here. Everything else. So as you start looking at this, you have this gross margin. That's how much is left. That's got to pay all your operating expenses. That's payroll, leases, marketing, utilities, all those things, right? So it has to pay all your operating expenses. So once we subtract our operating expenses, we have our operating profit margin. Then we take out our taxes and interest, right? And then we have our net profit margin. That's how much is left over. So if you look at this and you think about it, okay, Walmart, $520 billion in sales, their net profit margin was right around 11 billion. So, I mean, that's like, wow, that's crazy. It was 2% is what they had left over. And when you look at the very bottom, that net profit margin. So if we take our net profit in dollars and divide it by our sales, that's how we get that. Target had a 2.98, almost 3% profit margin. So profit had a net profit margin. So Target had a little higher net profit. Now, as far as gross margin, gross margin, again, you divide your gross margin divided by your net sales. Target had a lot higher gross margin. So, I mean, there's lots of things that we can look at with this. So this is where you'd start right now. So profit margin, when you start looking at this, you have to look at, okay, what's included? Because this is going to affect my total business, right? So net sales, how much you have in sales, how much your inventory costs, right? The operating costs, all those things are part of understanding profit margins. So you have to manage these things if you're going to be a retail manager. You have to manage all of these things. Those operating expenses, selling, general, administrative, those are huge, right? It's your payroll, again, your utility cost, your lease expense, or right, depreciation. All those items are going to be in there. And so managing these items to get to a higher net income is going to be incredibly important. So as a manager, you can look at your income statement and make decisions on where you should manage or what things you need to pay attention to. Now, when you analyze this, because those numbers are so big, I mean, we're talking $520 billion. And if you're going to compare yourself to like another company, like so if Target compares itself to Walmart, the numbers are just, you can't compare because the numbers are so big. So normally what we do is we do put these into percentages. And when we do the percentages, we divide everything on an income statement, right, on that P&L. We divide everything by sales to get it in a percentage. We talk everything as a percentage of sales. And that helps us as managers to look at certain things a little bit more. So that's one of those things that we do to make our lives a little easier is we analyze everything by percentage. Now, the other side, right, so you have the net profit margin. So you look at the profit side. The other side is this idea of asset turnover. Now, asset turnover comes from what's called a balance sheet. And a balance sheet just it tells you what your assets are, right? Those are all those things that are going to help you in the future. And those things are resources like your buildings, your inventories, your computers, right? Cash, all those things that are assets. Now, The other side of the balance sheet is your liabilities. That's what you owe. Okay. Those are things that you're going to have to pay at some point in the future. And then we have this thing called equity. And equity is just, it's the way I describe it when I teach accounting, like equity is a plug, right? So your assets have to equal your liabilities plus your equity. So if you know what your assets are, and most companies know what their assets are, right? They know how much their inventory is worth. They know what their buildings are. They know how much cash they have, all these things. So they know the assets. And most companies know what their liabilities are. And if they don't, they get reminders. They get bills in the mail, right? So these liabilities. So if we take our assets and we know that those assets have to equal the liabilities plus equity, basically equity is a plug. So whatever we need to put in equity to make it work. So if we have assets of 100 and liabilities of 80, in order for 100 to equal 80, we have to add equity of 20. That's a plug. So that's how we look at that. But when we start talking about this asset management thing, we need to understand, okay, we have assets, right? So these are all the resources. Now there's two types of assets. There's what's called a current asset. And current assets are all those things that you expect to use within a year, right? Or could be used within a year, like your cash and cash equivalents. That cash, you could use it all up in a year. Hopefully you won't, but you could, right? Merchandise inventory, you hope to sell it all within a year, right? Accounts receivable, that's money people owe you. You definitely want to collect that, as quick as possible. And now there's this inventory turnover thing. In inventory turnover, we talk about that. That's how many times in a year you have turned over your inventory. So the way that we calculate that is we take the cost of goods and we divide it by our inventory. Right. So now there's this other thing. There's current assets. There's also non-current assets. And these are things that are not likely to be used up within a year. Things like your buildings, right? Your computers, right? Intangible assets, like if you have a copyright or some sort of special patent or something like that, that's an intangible. But really, you have current assets and non-current assets. And the way that we analyze this is we take our total assets. So we add the current plus the non-current. That gives us our total assets. And we then we have our net sales and we divide it by the total assets. That tells us how many times we've turned our assets over, which is pretty good way to measure, how are we doing? Because the more you turn things over, the better off you are, right? So again, let's look at Target and Walmart. So we have our assets, cash equivalents, right? Merchandise inventory, other current assets, right? So at the very bottom, we have this total asset number. So we just add everything up. So when we add everything up, we see that, Target has like $42.7 billion in assets and Walmart has $236.5 billion in assets, right? So we have the total assets. We can then create these ratios. Now with the ratios, right, these are ways that we can calculate and say, okay, how are we really doing? So our inventory turnover, that's where we take our cost of goods and we divide it by inventory. And we find out that Target has a 6.1% inventory turnover, and Walmart has an 8.89 or 8.9. The higher, the better. The more things that you turn over, the better off you're going to be, right? So Target's turning over their assets 1.8 times, Walmart's 2.2 times. The higher the turnover, the better off you're going to be, right? So the return on assets, right? That's in the other way to look at this is we can take our net income, our net profit, and divide it by assets. So, right, Target actually has a higher return on assets, 5.3, and Walmart has a 4.5 ratio. So as we look at that, we have some things. Now, these are just, again, some ways to look at it, analyze things, and make some decisions. Now, when we combine these, right, Target has higher operating profit. They perform better than Walmart in some areas, and Target attains better overall performance as measured by return on asset. But Walmart has the higher asset turnover, which means they're more efficient than Target. And so when we start looking at that, efficiency really helps long term, because the more efficient you are, the better things will be. You control your costs more. All right. And so with that, that was just the overview of, I've almost forgot. I do have one more. So the implications as you go through this, right? This tells you, once again, as a manager, what you need to do. So if your profit margin path, if you're going through that, we need to either increase sales or reduce costs. That's it. If you're talking about asset management, right? You need to have less inventory in sales or less inventory as far as dollars go, but you have to have higher turnover, right? So you want to have the right inventory at the right time. And in order to do really well with this, right, you need to consider both, right? So as you're making your strategic decisions, these models can really help you focus on, do you want it more on sales and cost control, or do you want more on inventory management, right? So as you start looking at these, you got to make these decisions. So it really does help you focus as a manager when you understand both sides of this. So with that, we're going to dive into the next one. We'll continue this discussion and look at some pricing in video number 2.